So today I'm going to be studying Uniswap v3 and I'm going to outro this list here. It's probably going to take me a few hours, if not a couple of days to study each one in depth. And I'm going to be writing down the functions that I think are relevant for each one in this file. Uniswap v1 was launched in November 2018 as proof of concept for automated market makers, a type of exchange where anyone can pool assets and shared market making strategies. In May 2021, once Uniswap v2 introduced new features and optimizations, setting the stage for exponential growth in AMM adoption. Less than 1 year since its launch, v2 has facilitated over 135 billion, I think, in trading volume, ranking as one of the largest cryptocurrency spot exchanges in the world. Yeah, don't like this playlist here. Put something more chill. I'm just searching playlists on YouTube to put ones that I don't know, so I can listen to new ones. Maybe hopefully find a good one. Empowering developers, traders, and liquidity providers to participate in a secure, robust financial marketplace. Yeah, and I'm still running the other one. I haven't stopped, and it looks like Alchemy is a lot better than Infura, because so far I have around 410,000 blocks that I'm getting information, that I already got information from, and I started with 80, so at least 300,000 requests without reaching the limit. So maybe the 300 million thing on their site was true, and if that's the case, then I'll be able to get all the 14 million blocks in one go. I think that would be great. Today we are excited to present an overview of Uniswap v3. We are targeting an L1 Layer 1 Ethereum mainnet launch on May 5 with an L2 deployment on Optimism set to follow shortly after. Concentrated liquidity, giving individuals LPs granular control over what price ranges their capital is allocated to. Individual positions are aggregated together into a single pool, forming one combined curve for users to trade against. Multiple fee tiers, allowing LPs to be appropriately compensated for taking on varying degrees of risk. Interesting. So I wonder how the liquidity of the whole pool works with this, because if each investor can decide how much they're aggregating into each coin, how it's gonna work when, yeah, I guess by the same logic that the market works. You just supply and demand, but it's still how the whole market price works with that. I think that's where the arbitrage opportunities come from, because arbitrages function as a Nash equilibrium osmosis between different DEXs. So just like water reaches an equilibrium with salt through the membrane, based on how much exists on the density levels. Yeah, I think it's density and maybe pH levels as well. I think it works the same way with arbitrage, where the investors are responsible for a certain amount, but then if it fluctuates and gets out of balance with the overall market, arbitragers will go and arbitrage in order to make money, and by doing that they help the market reach an equilibrium of prices across all the DEXs. And then, of course, I think this is still possible because there's still enough friction between them and growth in the ecosystem in order to have space for multiple people to do it. even though everyone's using bots, so the amount of people that can make money is a lot less. Because of that, these features make Uniswap V3 the most flexible and efficient MMA ever designed. LPs can provide liquidity with up to 4,000x capital efficiency relative to Uniswap V2, earning higher returns on their capital. Capital efficiency paves the way for low slippage trade execution that can surpass both centralized exchanges and stable-focused MMAs. LPs can significantly increase their exposure to preferred assets and reduce their downside risk. LPs can sell one asset for another by adding liquidity to a price range entirely above or below the market price, approximating a fee-earning limit order that executes along a smooth curve. Uniswap's oracles are now far easier and cheaper to integrate. V3 oracles are capable of providing time-weighted average prices on demand for any period within the last 9 days. This removes the need for integrators to checkpoint historical values. Even with these groundbreaking design improvements, the gas cost of V3 swaps on Ethereum remained slightly cheaper than V2. Transactions made on the optimism deployment will likely be significantly cheaper. For the deeper technical, check out the white paper and the smart contracts. Nice. Concentrated liquidity. In Uniswap V2, liquidity is distributed evenly along an XY price curve, with assets reserved for all prices between 0 and infinity. In most pools, a majority of this liquidity is never put to use. As an example, the V2 DAI USDC pair reserves just 0.5% of capital for trading between 0.999 and 1.1. The price range in which LPs would expect to see the most volume and consequently earn the most fees. V2 LPs only earn fees on a small portion of their capital, which can fail to appropriately compensate for the price risk they take by holding large inventories in both tokens. I'm starting to think about a bunch of different things while I read this. That's why it's good to read out loud, so I keep focused, because my mind has this tendency of deviating all the time to think about a bunch of other stuff. Additionally, traders are often subject to high degrees of slippage, as liquidity is spread across all price ranges. In Uniswap V3, LPs concentrate their capital within custom price ranges, providing greater amount of liquidity at desired prices. In doing so, LPs construct individualized price curves that reflect their own preference. So there's probably a mathematical formula for the distribution. Yeah, that's not linear. It makes sense to be exponential because the way that market economies work. So it's closer to reality. LPs can combine any number of distinct concentrated positions within a single pool. An LP in the if DAI pool may choose to allocate 100 to price ranges, 1000 to 1000, and an additional 50 to the ranges. These ranges. By doing so, an LP can approximate the shape of any automated market maker or active order book. Users trade against the combined liquidity of all individual curves. No gas costs increase per liquidity provider. Trading fees collected at a given price range are split prorated by LPs proportional to the amount of liquidity they contributed to that range. Capital efficiency. By concentrating their liquidity, LPs can provide the same liquidity depth as V2 within specified price ranges while putting far less capital at risk. The capital saved can be held externally invested in different assets, deposited elsewhere in DeFi, or used to increase exposure within the specified price range to earn more trading fees. Alice and Bob both want to provide liquidity in an if DAI pool on Uniswap V3. They each have 1 million. The current price of Ethereum is 1.5 DAI, so 1500 DAI. Alice decides to deploy her capital across the entire price range, as she would have in Uniswap V2. She deposits 500,000 DAI and 333.33 ETH, worth a total of 1 million. Bob instead creates a concentrated position depositing only within the price range from 1,000 to 220 to 150. He deposits 91,000. I'm not gonna say his numbers because it's in English, so sorry. Worth a total of about 280,000. He keeps the other 800 to himself, investing it however he prefers. While Alice has put down 5.4x as much capital as Bob, they earn the same amount of fees as long as the ETH DAI price stays within the range. Okay, liquidity spread across the full price curve. Concentrated liquidity between. So she is spreading the liquidity through the full curve, and Bob is not. And Bob is more capital efficient by doing that thing. Bob's custom position also acts as a kind of stop loss for his liquidity. Both Alice and Bob's liquidity will be entirely dominated if the price of ETH falls to 0. However, Bob will have lost just 159,000 versus Alice's 1 million. Bob can use his additional 800,000 to hedge against downside exposure or to invest in any other conceivable strategy. Instead of providing equivalent liquidity depth as V2 LPs with less capital, V3 LPs can choose to provide greater depth with the same amount of capital as their V2 counterparts. This requires taking on more price risk incremental loss, while supporting greater amounts while trading and earning higher fees. LPs in more stable pools will likely provide liquidity in particular narrow ranges. If the 25 million currently held in Uniswap V2 pair was instead concentrated between 0.9 and 1.1 in V3, it would provide the same depth as 5 billion in Uniswap V2 as long as the price stayed within that range. If the 25 million was concentrated into the range, it would provide the same depth as 50 billion in Uniswap V2. I'm not sure if I'm really understanding this. The two below calculates the capital efficiency gains of concentrated liquidity position centered around the current price relative to allocating capital across the entire price curve. These two positions will earn equal fees and perform identically while the price remains between this range. So in sum you need less capital and for the same efficiency whenever the price is ranging, but I don't understand the curve still. I also think I'm gonna search more about liquidity because I think I understand, but I wanna understand it better. I think it's a place where people put their money and then based on that it works kind of like an investment fund where a bunch of people put money and then the fund decides what the money, how is the money going to be structured. I don't think they decide where the money goes to. That's the investors that decide, the people that provide the liquidity. But they do decide something. Yeah, I think that's where my point of confusion is. I think they decide the rate of change from coins. Yeah, how do they decide the price? That's the thing. I need to understand a little bit better the fundamentals, I think, and first principles of this. Because I'm not, I don't have a lot of, I have some knowledge on finance, but not a lot of it. when it comes to technical terms and formulas, equations, things like that. Decentralized finance, since its inception, has changed how people have dealt with their assets in the crypto markets. It was only after... Can skip this part. Liquidity pool is a collection of funds locked in a smart contract and on a DeFi platform where anyone can deposit their assets and receive rewards in exchange for providing liquidity to the platform. This with the help of an example. So it is what like I was talking about. You can provide liquidity to the Uniswap by depositing funds into Uniswap's liquidity pool. Further, traders use Uniswap to buy or sell crypto tokens, and in exchange for that, Uniswap charges a trading fee. Uniswap distributes the trading fee to its liquidity providers as a reward for providing liquidity to the platform. Also, I guess the protocol determines both the fees and the price of the coins based on this trading, and that's the bridge, I think. Yeah, the investors are the liquidity, and then they gain interest based on that, and the traders are moving around that liquidity. So the investors work like a hedge. And I assume there's always going to be... They will allow less borrowing, probably, than the amount of money that exists. I think that's how it works. Kind of like Eve does. Oh, we don't really borrow, actually. Probably. You can trade but not borrow, I think. And borrowing is another protocol. The various components of a liquidity pool are as follows: liquidity provider, person that moves the money, a pool of funds. A liquidity pool is a collection of assets where a liquidity provider can deposit his assets to be used by the platform. Maybe I should be writing down, I think I'm gonna put on this file some comments of the questions that I'm getting as I read this, so I can investigate further. So the first question that came to my mind is, what happens when people decide to withdraw large amounts of money? I think that's one of the questions I have. What happens when price changes? How is the price of each token determined? Which is important as well to understand how the Nash equilibrium is between DEXs. Because different DEXs are gonna have different protocols probably, which is different algorithms to reach the equilibrium for any imbalances that exist temporarily. And that's an interesting thing. I think one idea that I have is just, yeah, it might be a good idea to actually go for standard finance and look for the formulas and code the formulas. Create a file just with the standard formulas that are the most used. The only problem I have with that is that I don't trust those formulas really well, because I know from reading the Mendel Fractal book that these calculations for alpha are not really congruent with the way that reality probably works. Because they assume a normal standard deviation when it comes to price. At least, probably it's not like this nowadays, but at least the last studies I saw when it comes to finance and all of this kind of stuff. But maybe I'm wrong as well, who knows. So the question I need to ask, I think, is I probably have to search with my loop. I'm new. Sure. What's your question specifically? I might not know the answer because I'm relatively new as well, but if I can help, I will. So the question is, how is the equilibrium calculated between markets, I think. So how to calculate the optimal arbitrage? And I think I've seen some stuff talking about this, so it's probably something that I'm gonna definitely look for and try to parse it. Not parse it, but put it in coding format. Oh, first day? Thanks for the follow, man. I think it's you, Nick the Kicker. And yeah, if you want help, you ask a more specific question so I know what you're trying to do. Because before I can help you, I have to understand where you're coming from and what exactly you're trying to solve. How can I save the else statement just return false instead of going through the array? So I have array, maybe loop is not needed. What language is this? Python? No, const, probably JavaScript. How can I have the else statement just return false? But what's the problem here? Because you can just do return false if you wanted to. So, do you have the question? Is it a question or is it like a specific problem that someone is asking you? Return false if not divisible by 5. If the number is not divisible by 5. So do you know the remainder operator? Oh, you have here. So what you're doing here is if the number... So first thing, you're looping. So what does that mean? It means that you're gonna try to see if it's divisible by 5 for all the numbers between 0 and 5. And if you're trying to decide if it's divisible by 5, only 5 or not, then that doesn't make sense, right? Because you're trying to test for 1 and to test for 2, for 3. You only want to test this number. You don't necessarily want to test the other ones. Yes, loop isn't needed. The second thing is, I would ask you, in my mind at least, I'm not sure if that's the solution, but that's the way that I think. Why did you decide to push this S to this array here? What was the logic behind that? Hey Edison, how are you? I have to be careful because I don't want to necessarily give you the answer, because then you're probably not going to learn as much, but... I think the best way is trying to think, what do I want to achieve here? And then, what are the necessary steps to do that? When I look at something like this... Oh, you need to return the values then. You don't... So you need to return the number. Is this an assignment for something? Like, do you have the question, or is this something that you're trying to do in a bigger context? Because that would help me to understand what you want to do. If the question is return false, if the number isn't divisible by 5 and return true if it is, then that's one thing. If the question is return the number, if it is divisible by 5, then that's another. Just making your own stuff. And can you give me the context? Oh, so return the number if it's divisible, and if it's not divisible, return false. So you don't need to push into the array, you can just return the number. Like you can make the if check, just like you wrote it down, return the number if divisible. So if you put a check to see if it's divisible by 5, and if it is, then you return the number. If it's not, then is the else statement, and you're gonna put return false. So you don't actually need this array here, and you don't need this loop. Sure. This is Python, of course, but it's different. So function bank error num. So if num divisible by 5 equals 0, return num, else return false. That's it. And then you call bank error 5. And then whatever you put, if it is divisible by 5, you're gonna return the number, and if it's not, you return false. So I think I'm gonna go back to this. A pool of funds, a liquidity pool, is a collection of assets where a liquidity provider can deposit his assets to be used by the platform. The structure of a liquidity pool can be different on different platforms. A lending platform uses a single asset pool, where a pool consists of one asset only. A DEX generally uses a dual asset pool, making it a complete market for a particular pair of assets. Some platforms use pools of even up to 8 assets. Thus, the structure of a pool is something that is decided by the platform itself. Let us have an idea of how some of these platforms utilize their respective pools. So I think this is another factor, but it doesn't change much the arbitrage thing, because the balance is still gonna follow the same logic. Yes, it's a good day, Edison. Coding is fun, but so many things to figure out. Exactly. It never ends. But it's really... Once you start to understand how things work, it gets really fun. Once you start to build your own stuff. But it's definitely painful and frustrating, just like everything else. You just have to push through it and keep learning every day. Type of platforms using liquidity pools. Although many different decentralized platforms use liquidity pools to provide liquidity to the protocol, this can be broadly categorized as follows. Lending platforms, single asset liquidity pool, so just one asset. Also, this is the difference, I think. Some of the liquidity pools are lending platforms as well, like I was talking about with Aave. And that makes things a lot more complicated, I think. So what questions I have for that? So if you can have lending, borrowing. I guess the collateral is always bigger, and then you get liquidated if the price goes below a certain range. And that's something I also have to think about. So what happens if someone... Yeah, but I don't think traders can get... Well, they can get the money because they are allowed to borrow. So what happens if someone gets the money, the price falls, then they're probably liquidated. Yeah. So I think I'm gonna focus on the first part first, so I don't get confused. Then once I really understand it, I'm gonna try to understand this lending and borrowing stuff. Problem is it's all connected, of course, but one thing at a time. Lending platforms are simple, decentralized lending and borrowing markets. They use a single asset liquidity pool. In the case of single asset liquidity pools, a pool consists of one asset only. As you can see in the above image, Compound as a DAI token liquidity pool. Anyone who wants to lend his DAI tokens can deposit his tokens through the protocol into the DAI pool. In this case, the lender would not communicate with the borrower, but this transaction will happen between the lender and the smart contract. The lender would deposit his DAI tokens and would receive C tokens, which is, in this case, would be C DAI. C tokens can be understood as a receipt of DAI tokens deposited by the lender. In case the lender deposits ETH, he would receive C ETH. C tokens are a form of derivatives that derive their value from the base asset deposited by the lender. The value of these C tokens increases over time as it accumulates the amount of interest. From the borrower's perspective, a borrower would deposit collateral to receive a C token and receive a loan against it. As you can see in the above image, the borrower would deposit ETH as a collateral and receive DAI as a loan, and C ETH. In the case of the borrower, also the transaction is between the borrower and the smart contract. Now let's understand the structure of a dual asset liquidity pool. Also, Uniswap also allows lending. Interesting. The liquidity provider, token pair, LP tokens, token pair, DAI trading plus trading fees, ETH. So it works like a bank, decentralized bank, where you have people putting money and then people use that money to leverage. So does the trader have to put collateral? How does that work? Because what if the trader loses the money? I think that's where the concept of the atomic trades come in, and the flash loan, which is just for a couple of seconds, and it only works if the transaction is profitable. But I don't understand in other cases how this works. So I think what I have to ask is, yeah, what happens? How? I have to think more about how to structure this crash. Maybe what defines the that's not the best way to put it. So I'm trying to understand how does the mechanism for the trader works. How is the money decided for the trader? But that's not a good way to phrase it. What determines how much the trader borrow and collateral or hedge, let's say, against the amount borrowed. As discussed above, also Uniswap is one of the decentralized exchanges used for buying and selling crypto tokens. As Uniswap does not have an order book, like a centralized exchange, orders are fulfilled from the various liquidity pools created on the platform. The liquidity pool on Uniswap consists of 2 tokens, as you can see in the above image. There's the NIF DAI pool. Uniswap's internal algorithm called automated market makers decides the ratio at which both tokens would be deposited into the pool. Decides the ratio at which both tokens would be deposited into the pool. Oh, so it's deciding the distribution of the overall balance of each token, I think. It's like the portfolio management stuff. How automated market makers work. And that's the difference between the version 1 and version 3. Version 1 is a linear equation of distribution, which means every coin is linearly correlated, and I think for this Uniswap v3 they are using an exponential distribution. So I have to understand what determines the relationship between the exponential distribution of tokens, if that's what's happening. So for example, we're gonna have exponentially more ETH for each DAI you have in the pool. But then how do you decide which tokens are gonna be in favor of the other ones? That's the thing. Maybe I'm not understanding it right, but I think, at least from where I am right now, that's how I'm thinking about it. Basis Uniswap AMA price of an asset is determined based on the token supply in the respective liquidity pool. For example, in an ETH DAI pool, there are 20 ETH and 60,000 DAI. Price of ETH equals 33,000 DAI. Therefore, the value of the total ETH in the pool is 60,000, and the total DAI in the pool is also worth 60,000. MMA algorithm ensures and adjusts prices of assets in such a way that this ratio of the value of assets is always 1:1. So it is what I was talking about. So the price correlates with the whatever equation they're gonna put for the distribution of assets. Yeah, no problem, man. If you have any other things maybe I won't be able to help you now because I'm focusing on this, but if it's simple, then you can post and I'll see if I can think about it. So I need to think about the price as well. So price. No, I'm self-taught. I'm learning programming by myself. I quit university. I was doing mechanical engineering to play poker, and then I didn't make enough money through poker. And well, my plan was to start my business when I quit. So play poker part-time, get the money from poker, invest on my own business. That was my idea. But it was taking a long time to make money from poker. I was making some money, but not enough. So I had to stop for some time and focus only on programming. And now I'm not sure if I'm gonna get a job in programming, or my main goal is to make money by myself, either doing freelancing or something like that, or building my own team. And if I can't do it until the end of the year, then I'm gonna start looking for a job. But the overall goal is to take the money and invest on myself. Yeah, but blackjack is gambling, right? Poker is strategy. It's very different. It's still gambling, but if you take it seriously and you have good management skills, it can be a positive for you. But I wouldn't advise people to do it. It's just not a good habit, I think, to get. Still 50-50? No, poker is all about strategy. It is 50-50 in a Nash equilibrium, but based on the probability, 80% of the people are gonna lose money, 20% is gonna make all the money. And of course you have gambling addicts, and it's a zero-sum game, so it's not really positive for society, I think. But I was only gonna do that as a means to building my own team, because I was tired of and it's a lot harder when you're starting on your own, because it's harder to find people that also want to build stuff, and you need to have a team to build something most of the time. Maybe not on the beginning, but eventually you need to have a team. So now you need to network, and to make money. I thought it would be a better alternative to just play poker, because then it allows me to have flexibility. So in my mind, the idea was I'm gonna work really hard and I'm gonna make a bunch of money in some months of the year, and then the other months I can focus only on programming. And because I am the one that controls the amount of effort I put in, I can control the amount of money that I'm gonna make. But it doesn't work like that because of variance. And poker, the variance in poker is a lot bigger than I thought it would be. Yeah, I do. I've learned played poker for probably 3 years, something like that. And programming I started a little more than 1 year ago. And the highest stake that I got in poker was 50 NL, 100 NL actually. And then I had, I think, $4,000. And then I took a shot at 100 NL and I lost 7 or 8 buy-ins in like 1 hour, just on bad flips. And that was the point that I decided I had to quit and do something else, because it was taking too long to climb because of the variance. So that's why it sucks. Even if you put a very large amount of time, you still depend on the variance. And if you get unlucky on the transition between stakes, then you can get stuck for months or even years. That's the problem. What do you mean I never all in? The way that it works, you have a bankroll, and then you always play a stake that is lower than your bankroll, so you never go bankrupt. So for example, if you have $200, the maximum stake I would play is 10 NL, which is $10 a buy-in. And then if I drop 10 buy-ins, I go back one stake. Yeah, kind of like that. And whenever you have, depends on how aggressive you are. The most aggressive people are like 15 buy-ins, you move up. But usually nowadays is recommended to have at least 40 buy-ins. Yeah, man, it's really not good. But you live in, you learn, you know. It's a lesson. There's no failures, just lessons. And obviously, if you're gambling, you shouldn't do that. I would heavily recommend that you stop, and if it's hard to stop, then go just to poker and be really careful with the management side, which is the most important thing. So I will never put an amount of money that I can't lose. I just put the enough amount from a bankroll and I play with that. And if I ever reach 0, I would just stop. So I put 10 initially, then I lost those $10. And then I said to myself, I'm gonna put 10 more, and if it doesn't work, I'm never gonna play again. And then from those 10, I went to 24 and then to 50. And then I got hired by a team to play, and they invested 400 in me. Then around 6 months later, I hadn't made it. I made some profit, but just with the rake back. Then they decided to kick me out. Then I started for 15 bucks again, and then I climbed to 4,000. But then I had to stop once I lost the buy-ins on 100 and all, because I just said like, fuck this, the opportunity cost is just too big. It's not worth it to do it. Programming is a lot better because it's a skill that you can translate into a lot of areas, and it has a lot of compound effects, and can also be positive sum, where you can build something that is good for society as well. The most I won and lost when? In a day or in a couple of weeks? No, I don't count cards. I imagine it's really hard to do, so it probably takes a lot of training. I think the most that I lost was probably 40 buys or 30 buys in the span of 2 weeks, I think. Playing both 50 and all and 25 and all. And the thing is, once you start losing, then you start playing worse and makes it more likely that you keep losing. So the biggest thing for me is that it sucks because I was just doing that to climb the stakes and I didn't really enjoy it and it wasn't for me. And then every time you lose 10 buy-ins, you're thinking to yourself like, okay, now I have to grind 1 or 2 weeks more just to get to the point where I was. And that's even if I don't get less lucky. So I don't think it's worth it overall to play it. Unless you enjoy it, then it's another story. For example, suppose base... But the good thing about it, though, is that you can make some amount of money to start your own thing if you have nothing. So I could, for example, make 500 bucks and then take this 500 bucks and build my website, for example. Which is what I wanted to do in the beginning. For example, suppose Basis automated market maker buys 1 ETH 3000. I think already. No, didn't read this. Let's stop here. Then a liquidity provider will have to deposit his tokens in this ratio only if he wants to deposit 5 ETH. He would have to deposit 15,000 DAI along with it. Every liquidity pool on Uniswap acts as a separate market for that particular pair. In exchange for providing liquidity, Uniswap would give LP tokens, liquidity provider tokens, to the liquidity provider. Further, these LP tokens can also be staked to earn more rewards. So I think another question I have is how is the overall balance of all assets determined? When a trader exchanges his tokens on Uniswap, he'll give a fee to Uniswap, which is then distributed to the liquidity pool. For more information on Uniswap, you can read our beginner's guide to Uniswap. Therefore, liquidity pools help these platforms operate smoothly at all times. The most particular lending and DEX platforms are as follows. So Compound, Dave, Uniswap, Maker, Banker. I think it's the same ones I have on the picture I took. Yeah, here there are a couple more. Now let's understand how we as hodlers can earn some passive income through liquidity pools. How can you earn passive income from liquidity pools? As a hodler, we can choose a particular platform and provide liquidity to it. In exchange for this, the platform will share its revenue with us. So based on the platforms discussed above, there can be 2 options. So another question I have is, what about smaller liquidity pools? What happens when they are starting, and how is the price equilibrium reached? Let me think. Yeah, I still don't understand really well how the correlation between the amount of assets in the pool and the overall price of the token is determined. So maybe I should write this down, correlation. How do I write this? Correlation between price of a token and amount of tokens in the pool. I think that's the main point of confusion, I think, that I had from the beginning. So that's what I need to clarify. Sharing revenue with the liquidity providers, the flat platforms also airdrop their in-house tokens using known as liquidity mining. Liquidity pools help a DeFi platform by providing liquidity. Liquidity pools help a decentralized ecosystem operate without an order book, as it is as it is in the case of centralized exchanges. Liquidity pools are a very attractive means for holders to earn passive income. Possible limitations of a liquidity pool are as follows. Small liquidity pools always expose traders of a DEX to higher slippage tolerance. Don't know what this term means. I've seen it thrown around a lot, but I still don't understand exactly how it works. Small liquidity pools always expose traders of a DEX to higher slippage tolerance. A liquidity provider is exposed to the risk of impermanent loss in case there is a substantial change in the price of the assets deposited. But that's just a normal risk of cryptocurrencies, I think. So maybe I have to search for what is slippage tolerance. Slippage tolerance is an important term that you need to understand before executing a trade on decentralized exchanges. Slippage is one very generic term you would encounter when using a platform. So, what is slippage? When you place a trade using a decentralized exchange, you get an option to set your slippage tolerance. For example, here's a screenshot of Uniswap, where one could select the setting buttons to set their slippage tolerance. So I guess it's the fluctuations of prices or something like that. What it meant is, because of your order size, the amount of tokens you can get could be less than what's projected. So let me think about this. Because of your order size, the amount of tokens you can get could be less than what's projected. The above example, the tolerance level is 0.5%, and if the liquidity is not available or the price deviation is more, your transaction will not be fully complete. So if there's not enough liquidity or the price fluctuates. Also, it's pretty much the tolerance for that, I think. With slippage tolerance, you can set the maximum percentage of price movement you can live with. Anything above that and your order will fail to execute. The default for Uniswap is 0.5%, but you can set it to any percentage you want. So tolerance for deviations of price or assets in the pool. I think I'm starting to. So this kind of answers this question here that I had in the beginning. What happens when people decide to withdraw large amounts of money? So I guess when you borrow and you offer collateral, you can set up this slippage tolerance. And depending on how much it is, you're gonna be liquidated if it reaches the threshold. One solution to this problem is to use smaller transactions for exchange, but as the Ethereum gas fees are rising, it would be costlier to do many smaller transactions than one. For popular pairs, usually the price slippage is low and should not be a problem. However, when you are transacting with small cap coins, the slippage tolerance might be high and something you want to keep a check on. Okay. But that still leaves me with the question. Maybe I should be writing these things here actually, instead of here, because then I can mark them down in case I can answer them. So I know which ones I looked into and which ones I didn't. So I'm gonna put this one in the left. There we go. So what happens when people decide to withdraw large amounts of money? How's the price of each token determined? How to calculate the optimal arbitrage? Tolerance for deviations of price. So I want to understand how the slippage tolerance is correlated with the borrowing. This is also for swapping, which is when does this apply? We need to read more about it. I'm gonna read this one. Which tolerance apply? Imagine wanting to buy 10 apples at the market and seeing that the various apple vendors are selling them for 1 each. That's a 10 cost, easy. Well, what if there was breaking news that Apple's cure for... Now you're out 10,000 for the same 10 apples. When trading crypto, the volatility in asset prices can create such a situation where the executed price is different from the quoted and the expected price. Slippage is the expected percentage difference between these quoted and executed prices. Also, there is a delay between the price and I think I get it now. So this is pretty much the delay timing of different exchanges to determine the overall market price of the asset. Because in the pool is determined in one way and the overall market is determined another way, and reaches an equilibrium through the arbitrages, which are dependent on the friction of the transactions between exchanges. So we have friction, arbitrage, then overall markets, friction, arbitrage, exchange. But I'm not really sure if that's how it works, because I still don't understand how the prices are determined in the DEXs. So maybe I should be asking this question first. Low liquidity can also cause increased slippage, which is why larger orders tend to face higher slippage. And this is difficult for me to think about. So obviously when you have bigger order, you're gonna take the overall amount, you're gonna decrease the overall amount of an asset in the pool, which is gonna make the price deviate probably, and that's why the slippage is higher. It all boils down to what determines the price in the DEX of each asset. Because if it's just supply and demand, then I don't see how that would work for small DEXs. It would be the very different price. Yeah, I don't think that's how it works. But I think I'm getting to the bottom of what my main doubts are about it. Just pretty much the price. How is the price determined? This is generally a problem with market orders. When placing limit orders, your trades will only get executed at or above the limit price. but with market orders you buy at the price at which the market is willing to sell. When you use Uniswap, you'll see an interface like this. Note both the slippage tolerance and the price impact settings. With slippage tolerance, you can set the maximum percentage of price movement you can live with. So that's another question, I think, is because I don't think it's only possible to trade assets within the same pool, and that's how it works. Because there must be a way for money to get in and outside of the pool. So the swaps within the pool, I understand. We're just swapping one amount to the other. The swaps outside of the pool, I don't understand. Oh, they pass through the wallets. That's all. So you can only swap the amount that is inside the pool. I think that's what I'm confusing. But it's still a question about price though. How is the price determined? Because initially you're not gonna have anyone in the pool. So yeah, I guess it depends on those calculations of the percentage and the fees, both for trading and for the incentives for investing initially. But you still need to determine the price at these first steps, because there's not going to be any supply and demand in the pool, which has to be determined by the overall market. But then how do you set that in the beginning? Both the slippage tolerance and the price impact settings. With slippage tolerance, you can set the maximum percentage of price movement you can live with. Strategies. The most common strategy is to break up your order into small chunks and wait for any counter transaction to keep the slippage low. But there are a couple of nuances to consider. Each transaction has its own gas fee. Yeah, the other thing, so this interface takes care of swapping between tokens. So where does the depositing of assets happen? So if I want to deposit in order to be a liquidity provider, so maybe I should search through this lens as well. Should search how to be a liquidity provider. I think I'm gonna move this one up there because I think I already understood the answer. And I'm probably gonna move this up here as well. It's just something to remember. So my idea is what I need to do is, the reason why I wrote this is so I can transform this into equations and test based on data. I think that's the best approach. So I'd make a hypothesis and I test with the data that I have if that's true. And I should be getting probably data of these DEXs as well, to see the volume of money coming in and out and between pairs. That would be also something interesting to do. And that way I can start calculating the optimal, I can start coming up with equations that determine the flow of money between them based on this friction. Which should be hard to do, but not that hard, I think, because there are probably already equations for that with the optimal arbitrage. I just want to understand them better to see how the physics of the thing works. And then it's much easier to find opportunities when you can clearly see what's going on. The default for Uniswap is 0.5%, but you can set it to any percentage you want. Keep in mind that any trade moves the price of each of the two tokens being swapped between. Oh, that's the important part. Each transaction has its own gas fee, especially if the gas fee is high when you are executing these many micro trades. You could lose more in gas than gain in preventing price slippage. That's another question to ask, is that all these tokens have different protocols. So how does that impact the transactions? Because you also have mining pools, not mining pools, mempools between each token, which is the layer before the transactions get validated into the blockchains. And that's gonna have an impact between the strategies. So I think that goes into the friction part of the calculation as well. Because the mining determines the friction on the bridge there between exchanges. That's how it works. But I think that's probably something that is more important to figure out once I have all the other stuff figured out. Because it is important, but it's more of a detail. The principles, because the principles usually don't change, and what changes is the nuances. So I need to have the principles down in coding format first, I think. Keep in mind that any trade moves the price of each of the two tokens being swapped between. This movement may be insignificant for assets with large liquidity, market cap, and or trade with low volume. But if you place a large swap order for a token with a small market cap or liquidity, you can move the price by a lot. Practically, you are making each subsequent micro swap between these two assets more expensive for yourself. This is very difficult for me to understand because I guess each token is the price is based on the overall price of the tokens, the tokenomics. That's the thing that I'm not thinking about. So it's already built into the token, and the DEX only offers the supply and demand to that token. So the price is still managed by the overall price of the token, yeah, of course. And the DEXs are just a part of that dynamic. And the friction happens when you have these transactions between tokens. Yeah, but how does exactly that relationship works between the amount of money that exists on the pool and the price? Because it still doesn't answer the question of why would there be differences. So any trade moves the price of the token. I think the difference is in the borrowing. Because you need collateral to... So that's what I'm not understanding correctly yet. Place a large swap order for a token with a small market cap or liquidity, you can move the price well. You're making each subsequent micro swap between these two assets more expensive for yourself. There is no 100% right approach to approach slippage. You need to consider how volatile the price is at the moment, how liquid the asset, and the proportion of your swap's volume to the asset's cap and liquidity, and a number of strategic factors specific to your situation. You can also learn from the pros by finding your favorite active wallets and then following them and copying their trades. If you are wallet-to-wallet copying interface. And this looks interesting. So let me think about it for a second. Yeah, I think that the overall amount of money that exists in the pool determines the amount that it can be borrowed. Which affects the amount of things you can trade. But I still can think about the price. How would that affect the price? It's probably because I have to look at the code and this stuff here. Let me just... I think before diving into these papers, because they're probably going to be technical, I need to understand more of this higher level vision of how it works. Like, take more time understanding this. And starts getting really confusing when you have calculations between price and the deviation of assets with the price, because then I have to write things down. Because when price fluctuates, the amount of tokens you can borrow also changes, and the amount of lending you can do. No, the amount of lending stays the same, but yeah, it increases because the price increased, so you can borrow more. If market prices move outside of an LP's specified price range, their liquidity is effectively removed from the pool and is no longer earning fees. Yeah, so this is the confusing part. If market prices move outside an LP's specified price range. Their liquidity is effectively removed from the pool and is no longer earning fees. In this state, an LP's liquidity is composed entirely of the less valuable of the two assets, until the market price moves back into their specified price range, or they decide to update the range to account for current prices. So they're pretty much setting the tolerance, which I think is the slippage, for the amount of deviation that the amount of risk they want to take. I'm still trying to think in my head where the difference comes from in the prices. Because if the price is determined so only on the coin, the supply and demand of the coin, then I don't see why there would be any difference, because it would always balance out. I think I need to think about standard economics first. So if I have dollars and euros, how would that work? Because you do have forex arbitrage, so And I think I remember seeing or hearing people talk about that at some point. And then it starts getting very complicated because of all the politics and the rules and stuff like that. But if I think just about supply and demand, because the amount that is gonna be available is just more based on the promise because of credit. And then that's gonna affect the supply and demand because of the amount that is available, which is inflation, and then the regulation based on interest rates, and depending on each policy of each government. But how would that work? So I think it works just like I was talking about before, where it's like osmosis, where you have supply differences in supply and demand based on the local behavior of people and the amounts available, and that differences achieve an equilibrium over time through this process of arbitrage, because people find opportunities to buy an asset for a lower price at some place and sell it for a higher price in another place. And if it never adjusts, then people keep extracting. It's like a current where the money keeps flowing until it reaches an equilibrium, which is the maximum amount of money you can extract from the opportunity. And I think the difference is, yeah, it's kind of like a decentralized computation. That's how pretty much the market economy works. So it's kind of like a bunch of limbic systems connected across space-time, and then they have stimulus over the environment, and that propagates through the network, through money. I think that's how it works. So, and the differences between, I think, the amount of an asset available is kind of like density, is the density of space-time, I think. So but then it starts getting really complicated, because I don't think but maybe I should probably think about that on a higher level and see if it makes sense, because I think the analogy does make sense. Where I have different densities of space-time, and that determines the pressure and the flow of matter and the electromagnetic field. That's probably how money works, because it's just an extension, an abstraction. So collectively is a network of people that are propagating information through the electromagnetic impulses, and that is done through money, which is supply and demand. And the incentive is the limbic system, which is the supply, which is the demand. The supply is the prefrontal cortex. So each place around the planet has these structures, which are hierarchies of normal probabilistic distributions converging to Pareto probabilistic distributions through the lens of this market economy, which is the decentralized computation to adapt towards the environment. And the amount of money is the density, the flow of money is the arbitrage, which reaches the equilibrium depending on the properties of the space-time, given the regulations, which are the rules, the politics, that set the structure of the geometry in that space. And that's why different countries have different regulations and cultures, because they adapt to the ecosystem. So I guess the DEXs come into play with the same dynamics, where a small DEX has less density because it has less money, but it's still affected by the supply and demand, and the money flows because people find opportunity to throw arbitrage, and the market reaches a Nash equilibrium of the price given enough time and the flow of current. But as these DEXs fluctuate, the amount of the liquidity pool that exists in them through this process is like a wave in the ocean, in the same way that inflation is with the dollar and other countries, where you constantly have this fluctuation of the incentives and the flow of money based on the state of the universe. So it's just like a decentralized computation in order to adapt through the environment based on politics. And then obviously it gets really complex because of all the rules and regulations, not only between countries but companies, and yeah. I think I'm starting to gain more clarity, I think, about how it works. But I have to think what questions I have based on that. Yeah, I think the question that I have with all of this is, how is the amount, the available amount, correlated with the price? I think I don't understand that really well. How is the available amount correlated with price? So in this analogy, if it is correct, the amount is density and the price is the flow, maybe pressure. What? Seriously? It's a lot of money, man. Airbnb puts, and it went up. You made it in one day? Oh, it went down and you short. Oh, nice. Yeah, be careful with trading though. It's really, if you don't have strategy, you lose money most of the time. And even if you have strategy, you lose money most of the time. Just, but I guess that's how it works with everything. Only few people win, most lose. There's this book that I always recommend people, which I think is probably the best book I read about this, which is this one here. I don't know if you can see. It's by The Misbehavior of Markets by Mandelbrot. And that will allow you to understand. It's very difficult. I probably read this book 2 or 3 times and I still don't understand really well. But it's all correlated with physics, because everything is connected, obviously. Well, the difference between poker and the markets is that it's just a different level of complexity of the game. Poker is already really extremely complex, but when it comes to markets, you're gonna have all the stuff that I was talking about, which is governments, technology, all the environment, the biosphere, and the complexity just gets ridiculously high. So the rules of the game are different. The amount of strategies and how they interact with each other is different as well. It's a lot more complex. Yes, poker is a lot harder when it's online. I don't play much live. I didn't play live at all, probably. But that's what everyone says. Like if you play $1,000 buying live, is the same as playing $2 buying online or $10 buying. That's what people say. And the reason why? No, it's not rigged. I think, at least. They have too much to lose. Some sites are probably rigged, but the main ones are not. I think that... But you could say that it is rigged because it's so difficult to win that it's almost impossible. Yeah. What is poker 2-3? And I forgot what I was gonna say. But depending on the site, it's actually not that hard to make money because you have a lot of recreational players. They're just throwing money around, so it's not that difficult. The biggest problem, the reason why online is much harder than live is because when you play online, you can play a lot more volume, and the more volume you play, the faster it is for you to realize your edge. So in live, you're pretty much, if you're not playing against really bad people, it's gonna take probably decades for you to realize your edge, or even more than that. It might take more than a lifetime to realize the edge. So that's why in order for live to work, you have to be playing against really, really bad people. Yeah, each bankroll, each limit you climb, you have to double your bankroll or more. Because the higher you go, you also have to think that people are gonna play better, so you need even more money to sustain the downswings. But blackjack is all luck. It doesn't... It's rigged pretty much. So you're always gonna lose in the long term if you play blackjack or other games. Poker, most people lose, but there's the chance that you are the winner if you work really hard. And you play... And I think the biggest skill in poker is being able to play... Being able to make bad decisions frequently. Not bad decisions, good decisions, but painful decisions frequently. Because that's what most of the game is about. You know you're gonna lose money most of the time, and you gotta do it anyway. And the people that are capable of doing that frequently are the ones that win. Because it's not that hard from, at least if you're playing against humans, obviously, it's not that hard from a strategical standpoint to figure out what are the plays that make you money. Another issue that online has is that there's a lot of people cheating, and it's really hard to prevent people from cheating. Because you can use software outside of your computer that is telling you what to do, and you play exactly like on a computer. And most of the top sites have a lot of people cheating, especially at the lower limits, because the higher limits is easier to discover them. So it makes almost impossible to win, especially given the rake that it is very high. So yeah, it's ridiculous. They play pretty much using the solution of the game on another computer, and it's very hard to prevent that or detect that if the person cheating is really smart about it. Most of them are not, because they're cheating, so they obviously don't know what they're doing, but if someone knows what they're doing and they decide to cheat, it's probably pretty much impossible to figure out. Now, of course, no one's gonna tell you that because, yeah, for obvious reasons. Trading is more like banks and investment firms pay for marketing in order to sell people this dream that you can see patterns on a chart and make money, and they're doing that because they want liquidity, so they keep getting all these people to give them money in order for them to trade large amounts of money by selling them a dream and making them implement bad strategies. But I do believe it's possible to make money in trading. It's just extremely hard, and you're probably better off just betting on the market. Yeah, that's what market is, right? Market is manipulation. But it's the best we could do it so far, and I think it does serves a purpose, which is the decentralized computation in relationship to stimulus from the environment. So I think that's how it works. It's like that's what it converges to over time. It's a bunch of people deciding what's valuable for society over time. And because of supply and demand, the limbic system is always the thing that is going to determine what is important for society. And that's the biggest problem with market economies. Because it always boils down to addictive behavior, because that's what the limbic system does. And the power of the prefrontal cortex is not high enough, at least through the market lens, to correct that behavior. Because in individuals, you can have individuals that can control themselves by applying the power of prefrontal cortex, which is discipline, in order to recalibrate their limbic system stimulus. But at scale, I think the mass of people that follow more the limbic system is just bigger than the power of the prefrontal cortex to adjust that behavior, and that's why it lacks synchronicity. So because it follows a Pareto distribution, or 80% of the people follow more their limbic system, and it makes the system. So it's kind of like a balance where you have the limbic system going one way, the prefrontal cortex going another way, and the equilibrium is this pendulum of energy through time. Yeah, that's how it works. The rich get richer and the poor get poorer. The more poor. And that also happens because the regulations are built on top of the incentives of the structure itself, so it naturally gets corrupted by this relationship between limbic system and prefrontal cortex, which is the lack of power of the prefrontal cortex to create strategies that prevent this corruptive cycle by realizing that it's going to lead to destruction eventually. And there's also the problem that the individual is different than the collective, so everybody is selfish and thinks for themselves, which means that there's lack of coordination at scale in order to prevent that from happening. Because you can think, well, I know that global warming is a thing, and if we do these things, it's gonna ruin the planet, but I'm gonna die in 5 years, so I don't give a shit. And then it's hard to argue against that because it makes sense from one point of view. And it all boils down to this lack of meaning and understanding of what happens after death. So, because there's no shared meaning, which is the function of religion, I think, to collect people is a unifying force. But it can be very dangerous because of that, because then people use that to manipulate other people into thinking certain things, and that's the whole problem. And that's how the pendulum keeps swinging. No, I didn't. But yeah, I would like to, but it's very risky, right? Because if you take it, then you might never be the same again, and it's yeah, I don't know. It's just a very risky play. But maybe one day I will. I want to be wealthy, just well off enough so I don't have to work. But you're always going to work. That's the thing. It's impossible not to work. So we have to be careful with this thinking. Because I think everybody thinks that way. But the reason we think that way is because our limbic system is trying to make us not take the actions that are aligned with long-term goals, let's say. So you keep creating this abstraction that you're gonna do something in the future in order for you to remain in your comfort zone. Because you admit that you're never gonna be able to retire or focus on problems, it's gonna force you to put yourself in a position where you have to take actions that you don't want to take because they're risky or because they make you take energy. And the reason why we think that way is because the natural selection, because we evolved to think that way through time. And that's the whole problem of the relationship between limbic system and the prefrontal cortex. There's a delay between what your intuitive brain thinks and what your mind thinks. And everybody is constantly having these ideas and thoughts that make them justify these actions that are not congruent with the universe they live because they're always in delay. Yeah, just seems unfair to me. Some people are born financially independent and others are born in third world country fighting for clean water. I think everyone agrees with that, but the issue is how do we solve it, right? Because it's a matter of probabilities. You can't think about people, you have to think about probabilities. There's always going to be people that are born broke, always going to be people that are born rich. What's the right distribution? What's the right the probabilities and the rules of the system? And that's where it gets tricky because both you and me and everyone else is thinking they have the answer and they are right. And to some degree, we are all lying to ourselves because our limbic system makes us do that in order to justify our behavior, our selfish behavior. Because that's the function of life. Just save energy, gain power, and reproduce. And if you don't have meaning, or if you don't think that anything happens after death, then you're gonna be a Nazi pretty much because you think as people as status things. And I think that's what's happening with the culture today, which is a natural progress of the balance of this pendulum. Because before everyone was religious, then people understood that people use religion in order to manipulate others. And then we deviated to show the market economy, which is the lack of belief in the whole, and it's more individualistic. And now we're probably making the movement back to the religion side of things. But we need to find the right frequency to go from one side to the other so that the exponential attack doesn't destroy us. Yeah, probably. Hopefully someday. I stream all the time, but not every day. I don't have a schedule. Forces your brain to think outside of the box. Yeah, a lot of people, not just programmers, microdose. I think, I have an open mind to that for sure. I just think it's very risky and you have to be really careful because you never know what's gonna happen. And it is something that can change your whole perspective in life. It's just like ideas as well. That's why people have trouble with thinking about different ideas. Is because your brain has a natural resistance in order to think of different ideas, because ideas come with a risk. Because if you think a different idea, then you might take risks that you wouldn't take before, and that might lead you to die. And that's the whole ego thing. And that's why people like shrooms, because they say you die and then your brain is open up to all these different things. But too much of that can also make you, yeah, can also be not good. So it depends, because nobody has the answers to what is right or wrong, or if there is even right or wrong. So it needs a lot of thinking in order to do that. Yeah, empathetic. What did you see in your trip? Did you see the elves, machine elves that everyone talks about? I think a lot of people just took DMT because of Joe Rogan, probably. It got really popular. I think that it is possible. It makes a lot of sense to me that when you die is like a DMT tip trip, and because space time is just an illusion and it comes from infinity. The bottom ground of all realities needs to be infinity, because if it had a start and finish, it would be finished already. So in the bottom ground, it is infinity, and I think these molecules allow you to travel between dimensions of. So space time is part of this larger structure of different dimensions that interconnect with each other, and that's what these drugs allow you to do. And that's probably what happens after death as well. You just go from different dimensions. Yeah, that's intense. The average execution of fully executed range order is the geometric average of the minimum and maximum price. In Alice's case, the execution price equals this for total price. This execution price does not account for additional swap fees earned during the period in which prices trade within this range. Range orders within wider ranges may prove particularly useful for profit taking by deep and primary issuance events. The latter use case, issuers are now able to deposit liquidity in a single asset and specify the exact range of prices across which they wish to sell their tokens. Non-fungible liquidity as byproduct of per LP custom price curves, liquidity positions are no longer fungible and are not represented. Instead, LP positions will be represented by non-fungible tokens. However, common shared positions can be made fungible via peripheral contracts or through other partner protocols. Additionally, trading fees are no longer automatically reinvested back into the pool on LP's behalf. Over time, we expect increasingly sophisticated strategies to be tokenized, making it possible for LPs to participate while maintaining a passive user experience. This could include multi-position auto-rebalancing to consider your own market price, fee reinvestment, lending, and more. I am 28. Getting old. Yeah. Still young, but getting old. Uniswap v3 offers LP 3 separate fee tiers per pair, 0.05%, 0.3%, and 1%. This array of options ensures that LPs tailor their margins according to expected pair volatility. LPs take on more risk in non-correlated pairs like ETH DAI, and conversely take on minimum risk correlated pairs like USDC DAI. Although distinct fee tiers may lead to some degree of liquidity fragmentation, we believe that most pairs will calibrate to an obvious fee tier, which then serves as the canonical market. We expect like-kind asset pairs to congregate around the 0.05% fee tier, and pairs like ETH DAI choose 0.3%, while exotic assets might find 1% swap fees more appropriate. Governance can add additional fee tiers as needed. Uniswap v2 introduced a protocol fee switch which allowed a flat 5 basis point fee to be turned on by governance. Uniswap v3 protocols fees are far more flexible. Fees will be off by default, but can be turned on by governance on a peer pool basis and set between 10% and 25% on LP fees. Yeah, I feel old though, because my mind, I've been thinking like this for a long time, but in my mind I think like I'm 50 already. So I always think about myself as if I am 50, which might be a weird thing, but yeah. And I guess I'm just preparing myself through the midlife crisis and this other stuff. Uniswap v2 introduced time-weighted average price oracles. These oracles serve as critical piece of DeFi infrastructure, have been integrated into dozens of projects, including Compound and Reflexer. So this is an important thing, I think. Time-weighted average price oracles. These oracles serve as a critical piece of DeFi infrastructure and have been integrated into dozens of projects, including Compound and Reflexer. V2 oracles work by storing cumulative sums of Uniswap pair prices on a per-second basis. These price sums can be checked once at the beginning of a period and once at the end to calculate an accurate TWAP over that period. Uniswap v3 offers significant improvements to the TWAP oracle, making it possible to calculate any recent TWAP within the past 9 days in a single on-chain call. This is achieved by storing an array of cumulative sums instead of just one. This array of historical price accumulators makes it far easier and cheaper to create more advanced oracles that include simple moving averages, exponential moving averages, outlier filtering, and more. Despite this major improvement, the gas cost to Uniswap trader for keeping oracles up to date has been reduced by 50% relative to v2. The cost for calculating TWAPs in external smart contracts is significantly cheaper as well. Team believes security is for the most important, so this is another opportunity to make money. It's probably difficult, and less money should be made. Uniswap v3 is an extremely complex protocol and cannot guarantee all bugs have been discovered and resolved. Up to 500,000 offered for critical bugs. So let me think about what questions I have. I think the main one is how price is determined, so that's probably what I'm gonna look for. Reserves automatically rebalance after each trade. Uniswap pool can always be used to buy or sell a token. So now I'm gonna search for price and then I'm gonna read these papers, I think. Or maybe searching for how to, but this I'm gonna search later. How to become a liquidity provider. Liquidity provider tokens, LP tokens, are tokens that are allocated to liquidity providers on the DEX. The DEX runs on an automated market maker protocol. Decentralized exchanges or DEXs are peer-to-peer platforms where transactions can be made directly between crypto traders. DEXs are a way to facilitate financial dealings that aren't officiated or regulated by any intermediary, such as banks, brokers, and other financial institutions. The reduction in the use of intermediaries is an essential tenet of the blockchain community. This is one of the reasons why DEXs have grown in popularity alongside traditional centralized exchanges. The global cryptocurrency market relies on cryptocurrency. DEX provides a unique approach to the trade of digital assets. Decentralized exchanges do not require an intermediary organization to clear transactions. Instead, they rely on non-custodial. An automated market maker is a type of decentralized exchange protocol that uses a mathematical formula for pricing assets. Okay, that's the thing. It's a type of decentralized exchange protocol that uses a mathematical formula for pricing assets. And I guess that's the thing that changes between... Yeah, but then because on the stuff that I saw, it determines price between the tokens inside of the pool. But it doesn't determine the price of the token. So I think the market determines the price of the token. And this pricing is just the pricing in relationship to the balance. It's confusing. Each protocol may have a different formula. Let's take an example. Uniswap uses a formula x times y equals k. This equation x represents the amount of one token in the utility pool, Y is the amount of the other token. The total liquidity of the pool, which must remain constant, is represented in this instance by K. So the pool is always 100%. The amount of coins inside of the pool is going to be determined by the distribution, which follows this equation. So, but how is that reinforced? Yeah, so I think in order for you to deposit, you always need to deposit the balance that is proportional to what is currently available. Different AMMs may use other formulas. All of them, however, will make use of an algorithm as the method of determining prices. This may seem to be a difficult process. What issue does it help solve? For the creation of LP tokens, all assets used in the Ethereum ecosystem were inaccessible during their usage. Tokens are usually locked up when they have to be staked. This is normally part of the governance system. When it comes to DeFi, this concern can be solved by creating easily convertible assets in AMMs using LP tokens. The LP tokens allow the use of the same tokens multiple times regardless of whether they are staked in a platform governance scheme or invested in DeFi protocol. The indirect form of staking that LP tokens allow can help solve the problem of limited crypto liquidity pool. This method prioritizes the proof of ownership rather than staking LP tokens themselves. Liquidity pool providers are those people who add funds to a crypto liquidity pool. A liquidity pool is a large amount of money that traders can trade against. In exchange for providing liquidity to the protocol, LPs receive fees from trades that occur within their pool. How does liquidity pool work? So I can't look at this here. The provider, the pool. So the pool has the shares, which is the amount of liquidity that exists in the pool, and the trader swaps currencies based on the liquidity that providers are adding. For instance, in the case of Uniswap, for a pool of 2 coins A and B, providers must deposit 50% of coin A and 50% of coin B. The deposit actually helps the exchange work. In essence, liquidity providers are... So maybe another good question is, how is the distribution? Yeah, but I think I'm gonna answer that once I search for how should be a liquidity provider. My guess is that you have to deposit based on the overall amount that exists, but then let's say I want to only deposit USDT in a pool that has USDT and Ethereum. If it has 50% Ethereum, 50% USDT, can I do that? How is the 50% going to be reached, the distribution? So assume it's only going to allow you to deposit in proportion to what the pool has, but then the pool would have to determine the exact percentage for each token based on the overall, which might be what happens. So the equation is for the overall distribution, but then why would you need the equation? You just put the fixed percentages. So maybe it's both, maybe it is the equation, and then as a result of the equation you have the fixed percentages. Liquidity provide also have to think about how is this equation, what's the logic behind the equation itself, for distributing the assets. Liquidity providers are traders who place their crypto tokens on DEX to earn transaction fees. This is often called liquidity mining or market making. Transaction fees are usually expressed in interest rates. The interest rate varies depending on how much liquidity is available and how many transactions are in the liquidity pool. It is generally easy to add funds into a liquidity pool. The protocol determines the value of the rewards. For example, Uniswap Future charges traders 0.3%, which goes directly to LPs, to attract liquidity providers to their pools. Other platforms and forks might charge lower fees. AMMs work in a way that reduces slippage for large orders. This may lead to more volume on the platform. Slippage issues can vary between AMM designs. Pricing, as we mentioned earlier, is determined by an algorithm. In a nutshell, the price is determined by how the ratio between the two tokens in the pool has been affected after a trade. Also, the pricing is determined by the equation, but not the amount of tokens. So the pricing is not determined by the markets of the supply and demand of the overall market. It's determined by the supply and demand of the pool. And that's when the arbitrage comes in, I think. So it's based on both the distribution of coins, that the tokens that the DEX has, and the amount of liquidity being provided, which is gonna also change the price based on the formula, because it has to keep the equilibrium of the distribution of the different. So I think it's a fixed percentage of each token and the price is based on the fixed percentage according to the formula. So I'm gonna write this down of each token to see if it's correct or not later. Fixed percentage of each token, formula assigns the price in order to maintain the percentage of each token in the pool. And I think I'm gonna mark this as blue, so I know that it's something that I wanna look at. Slippage will occur if the ratio changes significantly. So it's kind of like a hedge for whenever people remove liquidity or add liquidity, large amounts of liquidity, or the price fluctuates a lot. Yield farming. To recap, unlike staking, yield farming does not involve locking crypto assets when validating transactions on the protocol. Yield farming allows someone to invest in liquidity pools of various protocols. In other words, LPs are lending their crypto and looking to receive interest for it. Let's look at a simple example of how to generate this kind of passive income. When adding liquidity to a pool on Uniswap and Swap or a different DEX, both the coins in the pool must be present in our wallet. Farmers will choose these pools based on annual percentage yields and the level of impermanent loss, which is affected by a coin's price volatility. So I'm probably not gonna write the things that I think will be good to do now, because then you might make me lose track. But what I'm thinking about is the important thing is gonna be to get data based on this flow of money, both on the liquidity providers and the traders, of course, because that's the important thing, I think. Because once you know the flow of each thing and you know the formula, you can find the optimal way, and then you can design an algorithm to check to spot the opportunities based on this data. And that's the challenge, I think. Yeah, but now I think at least I'm getting a lot more clarity from reading this and talking about it. And then I can, do some more other calculations based on that. But I don't think I'm gonna write this down because I'm probably, I'm gonna do this part first, where just gaining more clarity over what kind of stuff do I need. Then I think about what steps do I need to take that are the most important to build first. And I'm obviously gonna need more data than the data I'm getting from Ethereum. But they are definitely correlated as well, because it has to be. Because Uniswap is gonna interact with Ethereum and other tokens. So yeah, the smart contracts that are probably important are the ones that make the bridge, both between providers, liquidity providers, the token, smart contracts as well, the trading, the swapping, and the interaction between, understanding the interaction between that and the mining pool, or the staking, the proof of stake protocol on Ethereum. Once you have made your decision and have the 2 coins available in the wallet, you will need to go to the DEX and supply liquidity. As soon as you have made the transactions, you will receive liquidity provider tokens. The LPs measure the percentage of your ownership of the pool. You can move liquidity at any time. Various websites provide information on the yield farms that offer the highest value at the lowest risk at any given time. As mentioned previously, LP tokens are the rewards provided to someone that has assisted a DEX in creating liquidity. Essentially, LP tokens represent the share of the pool owned by a liquidity provider. The liquidity provider retains complete control over the tokens. Furthermore, the LP tokens can be withdrawn from a pool at any time. LP tokens help solve a potentially vital issue for DEXs, that of liquidity. Essentially, these decentralized exchanges are paying users because they require liquidity in order for trades to go ahead unaffected. When providing liquidity, users interact with the yield farm's smart contract. This determines how much of a contribution was made by someone and how much they need to be rewarded. And so let's say the difference is really on the supply and demand of different places. Because if you have, but it has to touch in order to be movement of the price, obviously. Because you need to have people selling and buying at that price. And I think the reason why this happens is just because of comfort. Yeah. Because otherwise everyone would get the cheapest price always, obviously. So these opportunities happen because the supply and demand of an asset is one in one place and another one in other place. And then the flow happens. Let's look at a simple example. You have contributed crypto assets that are worth 100 to a pool that is worth 1,000. You want 10% of the liquidity pool. Because of this, you are entitled to 10% of the LP tokens of that liquidity pool. Your LP tokens can essentially be farmed for rewards provided by the DEX, as a way to repay you for solving a liquidity issue. The rewards are proportional to how many LPs you own. LP tokens can be transferred and staked on other protocols. However, DEXs will look to persuade users against doing this. One strategy, for example, is to introduce auto-component farms, where the aforementioned rewards will be reinvested into liquidity pools. Yield farming works in the same way as one would deposit money into a bank, with the purpose of receiving interest to their deposit. A DeFi project will require users to temporarily send in their crypto assets to improve liquidity. Okay, I think this part you understand. Generally speaking, farming LP tokens is more profitable than participating in liquidity pools, however the farmer carries more risk. Maybe I don't understand. When contributing to a liquidity pool, the crypto owner will provide both ETH and USDT in exchange for them staking their crypto assets. You receive the yield. Yield farming can have a low average API, but can also sometimes reach 1000% to 3000%. So what's the difference? Because I thought that is the same as participating in the liquidity pool. I guess what they mean by participating in the liquidity pools is just the trading. Crypto owners will receive LP tokens when they contribute an equal amount of tokens to a pool. These tokens represent their stake in that pool. These LP tokens will be minted when adding funds to the pool. They are then burned when removing the funds. This ensures that the number of LP tokens owned always corresponds to the percentage of total pool ownership. There is no risk of permanent loss. Farming involves using LP tokens in order to stake them on a farm. Owners simply execute a smart contract to let the LP tokens be farmed. In this case, users will usually receive rewards in the form of another token. This process involves a higher degree of trust from the owner, as issues with the smart contract could put the deal in peril. Now know how LP tokens work. Liquidity pools can be both an effective way for a crypto investor to earn passive income and to contribute to a financial system that cuts out the middleman. In exchange for helping with the ecosystem, trades occur that will be rewarded. LP tokens show how much a provider can help. I'm gonna be right back. The people that built this were definitely really smart though. Right back. So I think now I'm probably gonna search for how to be a liquidity provider, or what determines the distribution of tokens, liquidity. Boom. Or maybe it's a good time to start looking at the code and the white paper. And then I can get questions from that and search them. Because the white paper is probably gonna talk about that, I hope. And it's gonna be different with each pool, I guess. Oh, this is the bug bounty stuff. I think I'm gonna put this on full screen. It's a trading venue for your C20 tokens. They must deposit pair tokens proportional to the current price. If they don't, the liquidity they added is at risk of being arbitraged as well. Must deposit pair tokens proportional to the current price. If they believe the current price is not correct, they may arbitrage it to the level they desire and add liquidity at that price. Liquidity deposit. Gross liquidity reduces price slippage for trades. Price curve defined by x times y equals k. More liquidity increases low slippage area. Yeah, that's the thing I was talking about before. Where you have two different ones gonna follow the equation for determining the price. And that's the reason why you can arbitrage, because if you're depositing in a proportion that is not... Yeah, but that's the part that I still don't get it really well. Because there's two different arbitrages here, I think. One is between different DEXs and the other one is between the difference in the proportion you're depositing, I guess. Whenever liquidity is deposited into a pool, unique token. Into a pool, unique tokens known as liquidity tokens are minted and sent to the provider's address. These tokens represent a given liquidity provider's contribution to a pool. The proportion of the pool's liquidity provided determines the number of liquidity tokens the provider receives. If the provider is minting a new pool, the number of liquidity tokens they will receive will equal square root of x times y. where X and Y represent the amount of each token provided. Yeah, but they're only giving. What if they only give one coin? So they're always trading one coin, I think. Yeah, maybe not. So every time oh, I guess I think I understand. So the Y is the liquidity token, and the X would be the real token, let's say, outside of the pool. And that price is determined by XY. That's why I'm getting this confusion. Because I'm thinking about XY being the tokens inside of the pool. But, oh, so now I think I get it. The equation is the bridge between the market outside and the market inside the pool. But I still don't understand this part where they say that people can arbitrage if you put a different proportion. To retrieve the underlying liquidity plus any fields occurred, liquidity providers must burn their liquidity tokens, effectively exchanging them for their portion of the liquidity pool, plus the proportional fee allocation. As liquidity tokens are themselves tradable assets, liquidity providers may sell, transfer, or otherwise use their liquidity tokens any way they see fit. Uniswap is unique in that it doesn't use an order book to derive the price of an asset or to match buyers and sellers of tokens. Instead, Uniswap uses what are called liquidity pools. Liquidity is typically represented by discrete orders placed by individuals onto a centrally operated order book. A participant looking to provide liquidity or make markets must actively manage their orders, continuously updating them in response to the activity of others in the marketplace. While order books are foundational to finance and work great for certain use cases, they suffer from a few important limitations that are especially magnified when applied to a decentralized or blockchain native setting. Order books require intermediary infrastructure to host the order book and match orders. This creates points of control and adds additional layers of complexity. They also require active participation and management of market makers who usually use sophisticated infrastructure and algorithms, limiting participation to advanced traders. Order books were invented One particularly interesting use case for flash swaps is capital-free arbitrage. It is well known that an integral part of Uniswap's design is to create incentives for arbitrageurs to trade the Uniswap price to a fair market price. While game theoretically sound, this strategy is accessible only to those with sufficient capital to take advantage of arbitrage opportunities. Flash swaps remove this barrier entirely. Effectively, it is exactly like I was thinking then. But they purposely made it like this so it reaches the natural equilibrium of the price. But then you need the money to make it work. Because otherwise you're not gonna move the price by doing the trades. Imagine a scenario where the cost of buying one ETH on Uniswap is 200 DAI, which is calculated by calling getAmountIn with one ETH specified as an exact input-output. And on Oasis or any other trading venue, One ETH buys 220 DAI. To anyone with 200 DAI available, this situation represents a risk-free profit of 20 DAI. Unfortunately, you may not have 200 DAI lying around. With flash swaps, however, this risk-free profit is available for anyone to take as long as they are able to pay gas fee. Withdrawing ETH from Uniswap. The first step is to optimistically withdraw one ETH from Uniswap via flash swap. This will serve as the capital that we use to execute our arbitrage. Note that in this scenario, you're assuming that one ETH is the pre-calculated profit maximizing trade. The price has not changed on Uniswap or ASIS since our calculation. It may be the case that we'd like to calculate the profit maximizing trade on chain at the moment of execution, which is robust to price movements. This can be somewhat complex, depending on the strategy being executed. However, one common strategy is trading as profitably as possible against a fixed external price. This price may be the average execution price of one or more orders on Oasis. If the Uniswap market price is fair enough above or below this external price, the following example contains code that calculates the amount to trade over Uniswap for maximum profit. Okay, great. So they already provide some example code for that. The following example contains code that calculates the amount to trade over Uniswap for maximum profit. I assume this Uniswap was feature. True price is expressed as a ratio, so both values must be non-zero. So the price is the ratio between the liquidity token and the normal token, I guess, which is the K of the equation for Uniswap V1. Caller can specify 0 further if they wish to swap so the equation is because the amount of liquidity provided. That's the thing, I think. So it tries to keep the price adjusted with the overall market as close as it can, but it obviously can't because the market has infinite possibility. So any big fluctuation of the markets are going to be susceptible for these differences in prices between liquidity pools and the overall market, which creates arbitrage opportunities. And that's why they did it this way, so that whenever this happens, it reaches equilibrium by this arbitrage. And then that's why they're warning there, I think, because you want to make sure that, because whenever you are depositing, there's always going to be this difference between the price depending on the amount of coins that exist on the liquidity pool, which is going to follow the equation. So if you're depositing ETH, but there's not a lot of ETH in the liquidity pool, the price may be a lot different than it is, which would make you instantly lose your money because someone would see your transaction to the liquidity pool, and you would use these strategies to both front run you or the sandwich attack thing or the arbitrage, because they know you're gonna deposit. They can do this thing where they're gonna increase the price. You're gonna make the trade before and then according to what they want, and you lose value. So I think I'm gonna copy this contract here. Example, swap to price also. I'll probably look at this later. Trade at external venue. Once we've obtained our temporary capital of 1 ETH from Uniswap, we now can trade this for 220 DAI on Oasis. Once we've received the DAI, we need to pay Uniswap back. We've mentioned that the amount required to cover 1 ETH is 200 DAI, calculated via getAmountIn. So after sending 200 of the DAI back to the Uniswap pair, we're left with 200 DAI of profit. Yeah, so you're pretty much reestablishing the equilibrium between tokens. But I'm still not sure which tokens it's talking about in the equation. I'm a little bit confused now because I'm not sure if it's in the relationship between tokens, different tokens, or the liquidity token and the standard token. Instant leverage. Flash swaps can be used to improve the efficiency of levering up using lending protocols in Uniswap. Consider Maker in its simple form. A system which accepts ETH as collateral and allows DAI to be mined against it, while ensuring that the value of ETH never drops below 150% of the value of the DAI. Say we use this system to deposit a principal amount of 3 ETH and mint the maximum amount of DAI. At a price of 1 ETH 200 DAI, we receive 400 DAI. In theory, we could lever this position up by selling the DAI for more ETH, depositing this ETH, minting the maximum amount of DAI, which should be less this time, and repeating until we've reached our desired leverage level. It's quite simple to use Uniswap as a liquidity source for the DAI to ETH component of this process. However, looping through protocols in this way isn't particularly elegant and can be gas intensive. Enable us to withdraw the full ETH amount upfront if we wanted to 2x leverage against our 3 ETH principal. We could simply request 3 ETH in a flash swap and deposit 6 ETH into Maker. This gives us the ability to mint 800 DAI if we mint as much as we need to cover our flash swaps. The remainder serves as a safety margin against price movements. Yeah, but this is V2, so let's jump into V3. I think I need to start from the bottom and go all the way down on this one. I'm not sure if it's gonna be the same or similar to this. Yeah, this one is gonna get into the equations thing. So I probably should be I'm gonna read this one first. Or maybe not, because the other one is probably a better introduction first, and then I jump into that. So I think I'm gonna close this one. Concentrated liquidity. The defining idea of Uniswap V3 is concentrated liquidity. I think I already know this stuff. Stablecoins pairs where the relative price of the two assets stays relatively constant. The liquidity outside the typical price range of a stablecoin pair is rarely touched. For example, the V2 DAI USDC pair utilizes 0.50% of the total available capital for trading between 0.99 and 1.0. The price range in which LPs would expect to see the most volume. Consider stablecoin pairs where the relative price of the two assets stays relatively constant. The liquidity outside the typical price range of a stablecoin pair is rarely touched. Price range in which LPs would expect to see the most volume and consequently earn the most fees. With V3, liquidity providers may concentrate their capital to smaller price intervals, 0 to infinity. In a stablecoin pair, for example, an LP may choose to allocate capital solely into the 0.9 range. As a result, traders are after deeper liquidity around the mid-price, and LPs earn more trading fees with their capital. We call liquidity concentrated to a finite interval of position. LPs may have many different positions per pool, creating individualized price curves that reflect the preferences of each LP. So Uniswap contains several liquidity pools, from what I understand by this. And each one has the individualized price curves that reflect the price of each one, which can be in specific ranges in order to maintain the relationship between the coins. So the range I assumed is the value of k, which is the constant. Which gives the graph. So maybe you always need to deposit 2 coins at the same time. That's why the graph is like that, so I think I understand now. Yeah, so the graph represents the relationship between different tokens with a constant, and the overall amount you're gonna deposit is gonna be a portion of the slope of the graph, depending on which way you wanna arrange your portfolio. And based on the previous graph, the first one that I saw, now I think that the equation is between, it is between different tokens. It's not between the token and the liquidity thing. So the equation is between different pairs. But they determine the price relationship, the relationship between tokens. It's very confusing. They determine the relationship between tokens when it comes to I'm not sure. When it comes to a fixed quantity proportion, they determine the price in relationship to a fixed proportion of the distribution of the curve. That's the thing that is most difficult to understand, which is very confusing. It's how the curve correlates with the overall price of the thing. of both tokens. As the price of an asset rises or falls, it may exit the price bounds that LPs have set in a position. When the price exits a position's interval, the position's liquidity is no longer active and no longer earn fees. As price moves in one direction, LPs gain more of the one asset as swappers demand the other, until their entire liquidity consists of only one asset. In vitro, we don't typically see this behavior because LPs rarely reach the upper or lower bound of the price of two assets, 0 and infinity. If the price ever re-enters the interval, the liquidity becomes active again, and in-range LPs begin earning fees once more. So outside of the range is pretty much the token is out of the pool. And when the price enters the range, then the token is in the pool again. But this price has to be determined by the market outside, otherwise it would never get into the pool again if it's outside. Yeah, I guess because the quantity is always the same, but then the price is going to fluctuate based on the quantity. So if you have 100 ETH and the price is $200 and the price falls into 80 and it goes out of the pool, then it comes back when it's at 100 again, and it doesn't matter that because the quantity is the same. But if people sell, then the price has to be higher than it was before until it comes back to the pool again. Because if you have 200 and then starts declining and then people sell, and you have 100 ETH, now you need the price to be double what it was before, so that the amount is the same, needed to be in the range that is tradable. And that's why it gets really confusing. LPs are free to create as many positions as they see fit, each with its own price interval. Concentrated liquidity serves as a mechanism to let the market decide what a sensible distribution of liquidity is, as rational LPs are incentivized to concentrate their liquidity while ensuring that their liquidity remains active. To achieve concentrated liquidity, the once continuous spectrum of price space has been partitioned with DEX. Ticks are spaces such that an increase or decrease of one tick represents 0.01%. Increase or decrease in price at any point in price space. Ticks function as boundaries for liquidity positions. When a position is created, the provider must choose a lower and upper tick that will represent their position's borders. As the spot price changes during swapping, the pool contract will continuously exchange the outbound assets for the inbound, progressively using all the liquidity available within the current tick interval until the next tick is reached. At this point, the contract switches to a new tick and activates any dormant liquidity within a position that has a boundary at the newly active tick. While each position has the same number of underlying ticks, in practice only a portion of them are able to serve as active ticks. Due to the nature of the V3 smart contracts, tick spacing is directly correlated to the swap fee. Lower fee tiers allow closer potentially active ticks, and higher fees allows relatively wider spacing of potential active ticks. While inactive ticks have no impact on transaction costs during swaps, crossing an active tick does increase the cost of the transaction in which it is crossed. As the tick crossing will activate the liquidity within any new positions using the given tick as a bar. In areas where capital efficiency is paramount, such as stablecoin pairs, narrower tick spacing increases the granularity of liquidity provisioning and will likely lower price impact when swapping. The result being significantly improved prices for stablecoin swaps. So I see. So as the price fluctuates, it maintains the integrity of the thing by offering the range. Oh, that's the first one. I thought I was already below. And it's still hard for me to understand the price thing though, after reading all of this. Maybe I'll have to look at the V1 first because it's easier to understand. Yeah, let me do that. So I think I'm gonna start from here. Let me read all this stuff. Okay. Uniswap is made up of a series of ETH ERC20 exchange contracts. There is exactly one exchange contract per ERC20 token. If a token does not yet have an exchange, it can be created by anyone using the Uniswap factory contract. The token does not yet have an exchange. So when you're creating, it's gonna be determined based on the tokenomics of the token, the supply and demand of the token. However many tokens you made available and what other people are trading. The factory serves as a public registry and is used to look up all token and exchange addresses added to the system. Each exchange holds reserves of both ETH and its associated ERC20 token. Anyone can become a liquidity provider on an exchange and contribute to its reserves. This is different than buying or selling. It requires depositing an equivalent value of both ETH and the relevant ERC20 token. Oh, okay. So that solves my question, I guess. Liquidity is pooled across all providers and an internal pool token is used to track each provider's relative contribution. Pool tokens are minted when liquidity is deposited into the system and can be burned anytime to withdraw a proportional share of the reserves. Exchange contracts, so I guess when you're burning, you have to burn both. That's the thing, because the proportion has to be there. Exchange contracts are automated market makers between an ETH ERC20 pair. Oh, and only works with Ethereum ERC20 pairs. So Uniswap is only for the Ethereum protocol. Which brings another question of how do you change between different protocols? I guess you can use a layer 2 for that. Which would be something like Polygon or something like that. Yeah, because you send to a wallet and then... Yeah, but there must be decentralized exchanges that make the bridge between them. Yeah, I think there are protocols for that actually. So the protocols themselves allow to make the bridge between different protocols, which is AVAX, I think, is one of them that makes the bridge between different protocols. Traders can swap between the two in the direction by adding to the liquidity reserve of one and withdrawing from the reserve of the other. Yeah, so that's not the provider stuff, that's the trader. So the provider adds both the tokens and the trader trades between them, maintaining the balance. So however much they're gonna deposit in one side, you're gonna get the equivalent in the other side. Since ETH is a common pair for all ERC20 exchanges, it can be used as an intermediary, allowing direct ERC20 trades in a single transaction. Users can specify a recipient address if they want to receive purchased tokens at a different address from the ones used to make a transaction. Uniswap uses a constant product market-making formula which sets the exchange rate based off of the relative size of the ETH and ERC20 reserves, and the amount with which an incoming trade shifts this ratio. Selling ETH for ERC20 tokens increases the size of the ETH reserve and decreases the size of the ERC20 reserve. This shifts the reserve ratio, increasing the ERC20 token's price relative to ETH for subsequent transactions. The larger a trade relative to the total size of the reserves, the more price slippage will occur. Essentially, exchange contracts use the open financial market to decide on the relative value of a pair and uses that as a market making strategy. They use the open financial market to decide on the relative value of a pair. I guess this solves my confusion. So the ratio is always between the tokens, the different tokens. The price is determined by the relative value of a pair on the open financial market. The only question is how they would do that. On the relative value of a pair. Just gonna take some time to think about this before I move on. So we have the liquidity providers, which are providing based on the ratio, based on the ratio, because they have to provide the same proportion for each token. So I think it's the same ratio. Yeah, there isn't a percentage for each one. It's just the ratio. And the ratio is always the same for every token. That's the thing. Or is it? And because it's based on the price. Yes, the quantity is always the same, but what changes, the quantity is constant, and what changes is the price based on the ratio. And then traders are gonna change that ratio by buying and selling. But if they are changing the ratio, then what happens with the person that is providing the coins? Because their distribution of the portfolio is gonna change as well. So let's say they deposit 7,000 USDT and 3,000 ETH, and then someone buys $2,000 with 1,000 ETH. The amount for the person would have to change as well, for the person that provided the liquidity. Yeah, it's so confusing. Maybe I'm gonna have to write it down on a piece of paper to try to understand, or maybe watch a video. Because this price thing is really making it difficult for me to understand. The small liquidity provider fee, 0.3%, is taken out of each trade and added to the reserves. While the ETH RC20 reserve ratio is constantly shifting, fees makes sure that the total combined reserve size increases with every trade. This functions as a payout to liquidity providers that is collected when they burn their pool tokens to withdraw their portion of total reserves. Guaranteed arbitrage opportunities from price fluctuations should push a steady flow of transactions through the system and increase the amount of fee revenue generated. Since Uniswap is entirely on-chain, prices can change between when a transaction is signed and when it is included in a block. Between when a transaction is signed. Traders can bound price fluctuations by specifying the minimum amount bought on sell orders or the maximum amount sold on buy orders. This acts as a limit order that will automatically cancel if it is not fulfilled. It is also possible to set transaction deadlines, which will cancel orders if they are not executed fast enough. The reason only one exchange per token can be registered to the factory is to encourage providers to pool their liquidity into a single reserve. However, Uniswap has built-in support for ETH, for USC to USC, trades using the public pools from the factory on one side of the transaction and custom user-specified pool on the other. Custom pools could have fund managers use alternate pricing mechanisms, remove liquidity provider fees, integrate complex three-dimensional FOMO-based Ponzi schemes and more. They just need to implement the Uniswap interface and accept ETH as an intermediary asset. Custom pools do not have the same safety properties as the public ones. It is recommended users only interact with audit open source smart contracts. Upgrading censorship-resistant decentralized smart contracts is difficult. If significant improvements are made to the system, a new version will be released. Free providers can choose between moving to the new system or staying in the old one. Possible new versions will be backwards compatible with the old version, similar to custom pool. Uniswap describes the project and directs users where they need to go. The Uniswap smart contracts live on Ethereum, anyone can interact with them directly. The Uniswap frontend is an open source interface designed to improve user experience when interacting with the smart contracts. Anyone can use the source code to host an interface or build their own. Hosted interfaces are independent of Uniswap and should comply with their hosting regulations. Factory contracts. I think I need to understand better before I jumped into the contracts. Because if I don't understand the ideas and the principles, I'm not gonna be able to do create good coding, I think. I guess the governance is important a lot as well, too. Because they can change the rules and then it changes everything. And then opportunities probably arise from that as well. Last model, Uniswap liquidity pools are autonomous and use a constant product market maker. This model was formalized in the smart contract implementation past a lightweight formal verification. The create exchange function is used to deploy exchange contracts for ERC20 tokens that do not yet have one. Once an exchange reserves, if reserve, also you can use these things here. I think I'm gonna get the Uniswap v3 ones instead of these ones. And the reason why is because Uniswap v3 is harder, so there's bigger barrier of entry, which means there's probably more opportunities if you understand it. The variables needed to determine price when trading between ETH and ERC20 tokens is ETH reserve size of the ERC20 exchange, ERC20 reserve size of the ERC20 exchange, amount sold input or amount bought, amount bought sell order. For sell orders, exact input, the amount bought output is calculated. Exchange rate, the exchange rate is simply the output amount divided by the input amount. Reserve size of the input, I guess this is a good thing, sure. Take a picture of. Your C20 calculations. So if reserve size of the input, your C20 exchange, if reserve size of the input, if ERC20 size, if reserve size of the output, that's that, amount sold or amount bought. There is a 0.3% liquidity provider feature swap from token A to ETH on the input exchange. There is another 0.3% Liquidity provider fee to swap the remaining ETH to token B. But the input deadlines. I'll be right back. I think I'm gonna stop here actually. Go for a run and then like continue to do this some other time. So the main thing that I have to think about is the price that I still not 100% sure of if I really understand what's going on. But I think now it's clear to me that the constant is, or the equation is based on the difference in trading pairs. I think the providers always have to put the right proportion based on that equation. So they can't put just the liquidity providers, they can't just put one token, they have to put both. And then the trading is also I'm not really sure about that, because what happens with the portion of the amount of the money from the liquidity provider once trades are done with that money? I guess the proportion stays the same, but then does the amount of money that the liquidity provider provided is gonna change or not? So if they put 5,000 USDC, 5,000 USD and 5,000 ETH, and someone trades, it's gonna change the distribution. So does that mean that the liquidity provider distribution is gonna change or not? And if not, then how does that work? I think that's one question. I guess that's the range thing that they were talking about. That's the thing. So whenever you put the money, you offer a range. I think that's how it works. So you offer the range in that curve that the graph was showing for and that's the slippage. I think now I get it. So that's the overall amount of risk you're willing to take between the trading pair that you're providing. That's how it works. Yeah, I'm pretty sure that this is how it works. I think I'm gonna erase this. Yeah, I'll continue this another time. Probably gonna continue this after I run today. So see you.